Hey guys, what's up? It's Max, back with another episode of The Young Investor. In today's episode, we are going to be going over something we haven't really gone over before. It is going to be my very first tutorial on this channel. We're going to be talking about how to get started in the stock market for a beginner. And it is honestly a little bit scary at first and confusing. And I remember when I very first started trading, it was a lot of just confusion and I was a bit scared just that I was going to lose my money. We're going to try and eliminate a lot of that and make your guys' experience a little bit smoother. We're going to try and break it into about 4 or 5 different categories and make it as easy to understand as possible. To start us off, we are going to start talking about a lot of questions that a lot of first-time traders have. We're going to talk about what a broker is and the different kind of brokers that there are out there. We're going to talk about how much money you should put in your portfolio at the very start. And we are also going to talk about the different kind of investments that you can do, the different investment strategies that are out there, because surprisingly there is a lot more than I'm sure you all think, and a lot more on those lines. On this channel we do focus on making personal finance videos. If that is something that interests you and it does interest you to become financially free, then please do consider subscribing. One of the main goals while investing is to try and limit your risk while still increasing your potential reward. One thing that we need to talk about right before we get into our 5 categories is just something that's extremely important but also extremely hard to master. It's something that I still haven't mastered, and it's something that a lot of investors that have been investing for a really long time still have not mastered. It's called FOMO, which stands for fear of missing out. When you make trades, especially as a brand new trader, it's something that brand new traders struggle with a little bit more than more experienced traders is. You need to make sure to keep your emotions out of your trades. It sounds a little bit stupid, but let me explain a little bit. So you'll hear someone on the news talking about a stock and they'll be like, go buy this, and you'll instantly just want to go and buy that stock. You won't do any research on the company. You won't know anything about the company even a lot of the times, but you'll want to go and buy it just because you don't want, you have that fear of missing out. You don't want to miss out on that stock when it goes up, so you want to instantly buy it. You want to make sure you have actual logic behind your trades. Otherwise, it'll hurt you and you'll lose a lot of money. I know for a fact you will. I've done it multiple times. So let's start with talking about what is the stock market and how does the stock market work. So the stock market is a global network of exchange where large sums of money are exchanged on a daily basis. But the stock market doesn't trade goods or services. They trade shares of companies. A share is a partial ownership in a company. So if I buy a share of Tesla, I technically own partial ownership of Tesla. I don't get any say in what Tesla does or anything like that necessarily, but I have partial ownership of it. So let's use this for an example. I can go and buy 2 shares of Tesla for $100 per share. So I buy 2 shares, $200 total. Tesla does very good next couple weeks and goes up to $110 per share. So I'm up $10 on each of my shares. $20 profit for both. At this point, I can decide to cash out my $20 profit, or I can leave it in if I think Tesla's going to keep going up over the next couple weeks. So at this point, I decide to cash out. I am now up $220. My $200 I invested in it at the start, and then my $20 profit. I can decide to either go and enter into a different company with my $220 or enter Tesla at a later time if it dips down and has a better price to buy in at. Some stocks have a little bit of an added benefit called a dividend. A dividend is something that the company pays you just for having their stock. They will pay you their dividend either every month, every quarter, or annually. So say I have 10 shares of Tesla and their dividend is $1, so I would get $10 every quarter for holding their stock. So that's how you can make passive income with stocks, just because every quarter I would get $10 for my 10 shares of Tesla. Now, since we've covered some of the basics on what is the stock market and how does the stock market work, let's move on to the different kinds of investors that there are and the different kind of groups. There is 3 main groups that almost all investors fit into. There is the day trader, the swing trader, and the position trader. Day trading is one of the most common trading styles that there is out there. It is also one of the most risky. Day trading is where you buy and sell your stock within the same trading day. You can hold it from anywhere up to a couple minutes to a couple hours, but you never hold into the next trading day and through the night. Day trading is normally done with a large sum of capital, so you would drop a lot of money in one stock for a short amount of time. So the stock price doesn't have to change a lot for you to make a decent amount of profit and sell the stock. That's one of the reasons why day trading is just so risky, just because you have to put so much capital into one stock for such a short amount of time that just about anything could happen and you could lose your money super quick. Or you could make a lot of money super quick. So there is some pros and cons to it. But one thing you have to be super careful about when day trading is that you don't buy and sell the same stock more than 3 times in 5 business days. Otherwise, you can be marked as what's called a pattern day trader. If you get marked as a pattern day trader, it differs from broker to broker, but you'll be put on some kind of penalty where most of the time it's where you can't do anything on your account for 90 days. So it's a pretty big penalty. The only way to really get around it is to have more than 25,000 in your account. If you have more than 25,000 in your account, you can day trade as much as you want. So it is really kind of worth it. Then there's swing trading next. Swing trading is where you buy and sell a stock anywhere from a couple days to several weeks. Swing trading is my favorite style for newer traders, just because you avoid using your day trades and you still are actively trading, so you get a good feel for the market, but it's not quite as risky as day trading, just because you don't have to put as much capital into one stock, so you can diverse your profile a lot more and it's a lot less risky. And our last trading style is what's called as a position trader. Our position trader is more of a long-term buy and hold. They buy a stock hoping that it's going to appreciate in the future, so they don't care as much what's going on in the news and the normal fluctuations in the market. The only time they really care about the news is if it alters their view on that company that they're holding. They normally don't make more than 10 trades in the year. Position trader is what's normally called as the opposite of a day trader, just because they don't buy and sell at all normally. Let's now talk about what a brokerage account is. A broker is what investors use to buy and sell securities like stocks, options, mutual funds, ETFs, stuff similar to that. Brokerage is much like your bank account. You can transfer money in and out of it. But unlike banks, brokers give you access to the stock market, options, mutual funds, ETFs, and much more. Some of the most common brokers are Webull, Robinhood, E-Trade, Fidelity, and much more. I would highly recommend Robinhood for most beginner traders, just because it's super easy, the charts aren't hard to read, and it's just super easy for most beginner traders. That's what I started trading on. If you'd like a free stock with Robinhood, it's in the link in the description. It'll reward you a free stock for using that link. So let's now talk about stocks versus options. I'm sure if you've heard of stocks before, you've heard of options before. So as we learned earlier, when you buy a stock, you're buying a share of a company, a teeny piece of that company, of ownership in that company. Options are a little bit different. When you buy an option, it's called a contract. You're buying a contract to buy 100 shares of a company at a certain price on a certain date. There's 2 different kinds of options. There's a call. A call is you putting a bet that the stock price will go up, and a put is a bet that the stock price will go down. Stocks are a little bit more risky, but they can also come with a lot more reward. We're now towards the end of the video. Let's talk about one of the most important things, which is how much money should you put in your portfolio as a brand new investor. I would never recommend putting a lot of money into your portfolio just because there's a good chance you could lose it. You're a brand new investor, you're not really sure how the market works, not really sure how it works, So I'd recommend never putting more than $100 in, just because there's a good chance that you could lose that. Like I said, the link in the description for Robinhood, you can get that free stock. You can already start using that free stock without putting any money in. I would think that's a very good start. Also, never put any money into the market you're not okay to lose, just because there's a good chance that you could lose it. Nobody can predict the market. Nobody knows what's going to happen. So there's a good chance that you could lose it. So be careful. Make sure to do your due diligence and understand what you're buying before you do buy it. Thank you guys so much for watching. I really do appreciate it.